Watch this for 3 seconds. That is every trading strategy that matters. 9 of them. By the end of this video, you'll be able to take any strategy you ever hear about and put it somewhere on that map. Here's the thing it took me far too long to understand. These 9 look like 9 different jobs. They are not. They are 9 answers to the same 2 questions. Question 1. How long do you hold? Seconds, minutes, hours, days, weeks, months, years. That sounds like a preference. It isn't. It decides your costs, your screen time, how often you are wrong, and whether you can do this at all while holding down a job. Question 2, and this is the one almost nobody asks out loud. What are you claiming everybody else got wrong? Because if you're buying, somebody is selling to you. You think you know something they don't. What is it? There are only 3 honest answers. You are faster than them. You know where their orders are sitting. Or you're playing a distribution that they are not. Speed, structure, statistics, time across, edge down. That's the whole map. Every strategy I'm about to show you is one dot on this grid. Watch where they land, because the pattern that shows up at the end is the actual lesson. I'll tell you now, so you can watch it happen. As you hold longer, your edge has to change. Speed stops working. Structure takes over. Then statistics. Almost nobody says that out loud. Let's go. We start at the far left of the map. Seconds. Market making and arbitrage. I'm covering these first so that I can tell you not to do them. A market maker quotes both sides at once. Buy here, sell here, keep the difference in the middle. Then do that 10,000 times a day. Arbitrage is the same instinct. The same asset, 2 different prices, take both sides at once. The edge is pure speed. And speed here is not a skill. It is a purchase. Servers in the same building as the exchange. Direct data feeds. Microseconds. You would not be competing against traders. You'd be competing against infrastructure budgets. If your order travels over home Wi-Fi, this is close to you. That's not me being discouraging. That is just where the line sits. Edge speed. Holding time, seconds. 1 notch right. Scalping. Same instinct as the last one, except a human being can actually do this. You take a small piece of one move, and you are out. Look at this. 1 minute chart. Entry here. Stop 12 points below it. Target 18 points above. You are in this trade for about 90 seconds. 18 divided by 12. That's 1.5 R. And here's the part people skip. Your spread and commission on that trade is roughly 2 points. 2 points out of an 18-point winner. 11% of your profit gone every single time. Do that 40 times in a day, and your transaction costs are the largest position in your account. Scalping is not about being right more often. It is about whether your edge survives its own costs. Edge speed. Holding time, seconds to minutes. Still on the left side, news trading. A number drops. Interest rates, jobs, earnings. Prices already moved before you finished reading it. The edge is not knowing the number. Everybody receives the number in the same instant. The edge is being quicker at deciding what it means, or knowing how everyone was positioned before it landed. And look at what actually happens. The first move goes both directions inside 1 second. That is not indecision. That is stops being taken out on both sides of the market. Then it picks a side, and that move is the one that lasts. If you're trading that first second, you are back in the infrastructure game. If you're trading the reaction to the first minute, you are doing something different. And that's on a map too. Edge speed. Holding time, minutes. Now the edge changes. This is the part to pay attention to. Day, trading momentum. And after the open, flat by the close. You're no longer claiming that you are faster than anybody. You're claiming you can see where the day's orders are sitting. 5-minute chart. The opening range, the first 30 minutes. Price breaks the top of it here. So where's it going? To yesterday's high, because that is where the resting orders are. Entry on the break. Stop underneath the range. Target that high above. 22 points of risk. 66 points of reward. 3R. You are not predicting anything. You're reading a map of where other people already committed. Edge, structure, holding time, hours. Breakout trading, same edge, longer leash. A market goes quiet, the range gets tight, and everybody stops pile up just outside it. Look at the range here. 6 sessions going nowhere, volatility compressing the whole time. Then it resolves, and the move is large because the stops on the wrong side become the fuel for it. Entry above the range, stop back inside it. And now the honest part. Most breakouts fail. This is a low win rate strategy by design. You take a lot of small losses in order to catch the few that actually run. So if you cannot emotionally survive being wrong 6 times in a row, this strategy will remove you from the market, no matter how good the setup is. Edge, structure, holding time, hours to days. Smart money concepts. If you've watched this channel before, this is the one you already know. Same family as the last two, structure, but it is explicit about the thing the others only imply. It says, price moves to where the orders are, and the orders are wherever everybody put their stops. 2 highs at the same price. Everyone's stops are sitting just above them. Price runs straight through, takes them, and immediately reverses. That's the sweep. Then it moves away fast, and it leaves behind a gap that it never traded through. Price comes back to that gap and carries on. Entry inside the gap. Stop above the sweep. Target the pool of orders below. And whatever you choose to call all of that, the mechanic underneath, it is the oldest one there is. Fill a large order in the place where the liquidity actually is. Edge, structure, holding time, hours to days. We're crossing the middle of the map now. Swing trading. Days to weeks. You place the trade, and then you close the laptop. 4-hour chart. An uptrend. Price pulls back into this zone. You buy the pullback, not the high. Stop underneath the last low. Target the next high, and then you wait. 8 days, maybe 12. Here is what changes when you hold something that long. You lose the ability to watch it. The position moves against you overnight while you're asleep, and there is nothing you can do about it. That is not a flaw in a strategy. That is the trade you accepted in exchange for not needing to sit a screen. And swing trading is the first strategy on this entire map that somebody with a full-time job can genuinely run. Edge, structure moving into statistics. Holding time, days to weeks. Now the edge changes one last time. Mean reversion. The claim is simple. Price is stretched too far away from its own average, and it will come back. 20-day average here, and price is all the way out here. You're not predicting a top. You are saying, statistically, this far out does not persist. So you sell it, you target the average, and you get out. Now, look at the shape of this thing. You win often. You win small. Really, really often. Which sounds wonderful, right up until the one that doesn't come back. And that one is bigger than all of the winners in front of it combined. That isn't bad luck. That is the design of the strategy. High win rate, and the losses are the big ones. Remember that shape. In about 90 seconds, I'm going to show you its exact mirror image. Edge statistics. Holding time days. The far right-hand edge of the map. Trend following. Months. Sometimes years. And here is the mirror that I promised you. You enter when a market makes a new high, and you are wrong most of the time. Watch. False start. False start. Stopped out. Stopped out again. And then this one. One trade that runs for 11 months, and it pays for every single one of those losses. Low win rate. Enormous winners. Is mean reversion turned exactly upside down. And now watch this, because this is the most useful 30 seconds in the video. Say the trend system wins 3 times in 10, and the winners are 6 times the risk. 3/10 times 6, minus 7/10 times 1, plus 1.1 are per trade. Now the mean reversion system wins 8 times in 10 small, loses twice big. 8/10 times 1, minus 2/10 times 3.5, plus 0.1 R. Both of them make money. Same arithmetic. completely opposite experience of being a trader. In one, you are right constantly and occasionally taken apart. In the other, you are wrong constantly and occasionally paid enormously. Neither one is better, but you can only live inside one of them. Edge statistics. Holding time, months to years. That's 9. Now look at the shape of it. On the left, everything is speed. Through the middle, everything is structure. On the right, everything is statistics. And notice there is nothing in the top right corner. You cannot be faster than a market for 6 months at a time. Speed decays. And there's nothing down in the bottom left either. You can't run a distribution on a trade that lasts 4 seconds. You don't have the sample. The map has holes in it, and the holes are real. So, which one do you pick? Wrong question, and it's the question that every video like this one ends on. You don't pick a strategy. You pick a column. Be honest about your actual life. If you have a job between 9 and 5, the entire left half of this map is closed to you. Not difficult. Closed. That leaves 4, not 4 out of 9 to choose between, for that you can physically execute. Then you pick your row, and that one has nothing to do with your schedule. That one is temperament. Go back to those 2 shapes. Being right 8 times out of 10, and occasionally taken apart. Or being wrong 7 times out of 10, and occasionally paid enormously. Most people find out which one they are by losing money inside the wrong one. You can find out right now, for free, by being honest with yourself for 30 seconds. The strategy is downstream of the column and the row. It was never the first decision. So here's what to actually do tomorrow. Open a chart. Don't pick a strategy. Write down 2 things. How long you can realistically hold a position, and whether you would rather be right often or paid big. That's a column and a row. It leaves you with 1 or 2 strategies instead of 9. And now you've got something you can actually go and learn properly. Everything on this map has a full episode behind it. And the structure ones, the amber band, that's what this whole channel is about. One last thing, and I do mean it. Nothing in this video is financial advice, and nothing in it is a promise about returns. It's a map of how these approaches differ from one another. What you do with it is on you. See you in the next one.